The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady. And it's tax season. And officially, the IRS opens up on Monday, but they actually are doing acknowledgments a little at a time now.
Yep.
So, and I got Tiffany Fabian joined in studio with me. Hey, Tiff.
Hey there, Esther. Happy Saturday.
Happy Saturday. And, you know, every week we try to give you kind of like a pointer so that you understand what happens to your own taxes. And so that's really our thrust of the show today. We're going to explain how the tax return works because a lot of people have no clue. Yeah. And as the weeks go on, we'll kind of tear apart each section of the return so you understand the complexity of the tax law.
Yep. And just want to chime in and say all of our 30 offices are open to serve you 9 to 9, Saturday 9 to 5, and the McKinley Mall is there.
Open on Sunday.
It's open tomorrow.
All right,
on
but
Sunday.
before we go into our things, and again, 8030930, 8030930, star 930 on a cell phone on our website is egtax.com. We had Bob in Virginia who have been waiting a long time. And Mr. Bob, you've been waiting so long. How can we help you, sir?
You can help me by telling me how I can deduct some of the loss I've got with this recent weather. I've had to water in the basement. It's cost me almost $9,000.
You know, here's the sad thing. Under the new tax reform, casualty losses are no longer deductible on the federal return unless it's a federally declared disaster area. So your particular problem, like I had somebody this morning said that his house burned down. Well, unfortunately, that's not a deduction on the federal. However, on New York State, the casualty loss law is still in place. So while you can't deduct it on the federal, you can deduct it on New York State. So you want to make sure that you document the loss of everything, like what it cost, what it was worth just before the flood, what it was worth after the flood, which I'm assuming would be nothing. And the other thing, you have to make sure that it was not due to your own neglect, wear and tear and things of that nature. So that would be deductible next year, because it just happened, on your New York State return, not deductible on the federal.
Okay. And that includes getting it repaired so that it doesn't happen again?
Nope. It's strictly the loss.
Strictly the
loss. So now, let's say that, and I know this might not be your situation, but let's say that a bulldozer was digging a basement next door and hit your foundation, which then caused the loss. Then the casualty to the foundation would be part of it. But if just because your basement leaked, fixing your basement is what you should have done from the get-go, as far as they're concerned. They're not the insurance company. They're there to kind of help you if you sustained a loss that wasn't covered by insurance.
Okay, thank you.
Thanks, Bob. Okay, I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, and I'm going to sneak in Virginia because she also waited a long time. Hi, Virginia, dear. What can we do for you?
Esther, I turned 70 and a half this year.
Okay.
On my distribution, should I take the taxes out before I take the money or have the bank take the taxes out now?
Okay, so in 2019, you have to do an RMD.
Yes.
How big of an RMD?
About 20.
20,000. Are you single or are you a widow or?
No.
You're single.
Yes.
Okay.
Widowed.
Now, besides the 20 from your RMD, do you have any other source of income?
Social Security.
And?
20.
And anything else?
No, that's it.
Okay, so your Social Security is not going to be taxable. So the only thing that's going to be taxable is the is the RMD, your standard deduction is going to be almost 14. So what's going to be taxable is about $6,000 times 10%. So your tax bill is $600. That's under $1,000, and you actually can just plan on paying it next year, and there's no penalty.
Okay, but should I have the bank take the?
Well, you don't have to. You can actually pay it next tax time, so you get the use of the money all year. But if you do want it withheld, just have the bank take $600 out in federal taxes when you do the RMD.
Okay, I have money. I have like 10 in one bank, 10 in another. So.
Okay, you can actually, if they're both IRAs, you can take it out of the you can put them together and take out your RMD out of one of the banks, and I would take it out of the worser performing IRA.
The lesser. Okay, fine.
Now, okay?
So then I'm so sorry. I should take it out beforehand, or
no. You're going to withdraw the taxes when you take out your RMD.
I'm going to withdraw.
So you're going to say, bank, please take out. I need $20,000 to fulfill my RMD. Please withhold $600 in federal taxes, because there'll be no New York State taxes, only federal, and about $600.
Okay.
Okay.
Esther, I was going to put those in my money in a money market account. Is there anything else you think I should do with that money?
You mean with the 20 that you're taking out because you don't need it?
Yes.
Well, I mean, putting it in right now, you should be able to get 3.5% if you put it in a CD. If you have an investment advisor who thinks that they can do better for you, you might want to call the financial guys. But I'm getting like 3.5% on CDs right now.
Okay.
Okay.
All right.
Thanks, Virginia.
Thank you very
Thanks
much.
for calling. Bye-bye. I'm Esther Gillius, the tax lady from EG Tax. We have 30 area offices to serve you. We're open 9 to 5 on Saturday, 9 to 9, Monday through Friday, and we want to help you. And I know everybody's just starting to get their stuff, and they're getting antsy, and we're there to help them, right?
We are.
All right, we're going to take a short break, and we're going to be back on the other side with Mike, Doug, Linda, and your calls. That's to get your motor running. I'm Esther Golias, the tax lady from EG Tax. We're here in studio with Tiffany, Fabian. Chris is writing tax returns. We have 30 area offices open 9 to 9 Monday through Friday, 9 to 5 on Saturday. Our McKinley Mall office is open up in Hamburg.
Yep.
On Sundays. Okay, we're going to go to the phones and we're going to talk to Doug. Hey, Doug, how can we help you, sir?
Well, I have a question for you.
Yeah.
Under the new taxation, a salesman who is an employee, unlike an independent salesperson, deduct for mileage. What can be done by the company in order to compensate that, and the company still gets a tax deduction?
Okay. You want to talk?
Yep. Your company should move you to an accountable plan versus an unaccountable plan. So that's where you turn in all your mileage, all your expenses, all your meals, and that's called an accountable plan. And when that occurs, they would write you a check for all those expenses that you have incurred. And a lot of times when that happens, they might want to cut back your pay a little bit, but the truth is you'll all be made whole because you'll save money on taxes.
So let's say that you made $100,000 and your expenses are $20,000, and then they set you up on an accountable plan. So you turn in your expenses, they give you $20,000, but the company says, Doug, we can't afford to do this and pay you $20,000. So what they do is they reduce your salary to $80,000.
But it's not a salary; it's a commission.
Okay, well, however they want to do it, if you were getting about that much, they would cut you back for what they're reimbursing you so that you're still getting the same dollar amount, but when you get reimbursed on an accountable plan, it's not taxable. Because right now, an employee cannot deduct their expenses that they incur. Now, if you were self-employed, you could do it. But if you're an employee, you can't. Except on the state of New York, they'll allow you to take the expense. But on the federal, the only way to do it is to take less commission and more accountable, and so that the compensation works out. Total dollars to total dollars are the same. You save an FICA, the employer saves an FICA, and it's going to be fully tax-free to you. That's what I'd suggest. That's what we've been telling people for a year.
Mm-hmm.
Okay, but what is confusing is that, let's say, for example, your commission is 10% of sales.
Okay.
As a base.
Yeah.
Now, at the end of each month, let's say, for example, can they take and change your commission and give you that money, and you're not really, because somebody said you can't take it out of the commission, and I get that, but I don't get why they can't. It's confusing to me.
What do you mean you can't take it? You mean the reimbursement?
Yeah.
Well, the reimbursement is a reimbursement. It's tax-free. A commission is taxable.
Hey, let's say at the end of the month.
But if they're just giving you extra money without it being accountable, like they just say, Doug, here's $500 a month, that's extra income to you. It's got to be on an accountable plan. And I don't, unfortunately, have the time right here to work out your pay structure. But if you wanted to call the office, we would be very happy to work with you and your company. If somebody puts their thinking cap on, they'll see a way that they can compensate their employees so that it's not taxable, and so they aren't hurt by this change in the tax law.
And the company does.
All right,
okay
so
too.
you can call me at 632-7886, or you can email me through my website at Ask the Tax Lady. Love to help you, but we've been telling people this was going to be a problem.
Yeah, well, it definitely is.
And
okay.
it's hard to,
All right, Doug,
it's
I'm
hard-
sorry I can't spend more time
It's
with you.
a lot to wrap your mind around. It really is.
Well, the thing is, it was interesting. We saw Ruth Bader Ginsburg's thing,
Movie.
and she was was taking something to tax court because the law was being unequally applied.
Right.
And so she won because she said that men were being
Can't say
discriminated
you can't
against.
hire.
Right.
Right.
What's interesting, employees who are incurring expenses that the employer is not reimbursing them for are being discriminated against, because if they were self-employed, they'd be able to
Correct.
take it.
Yep.
So
yep,
that's
yep.
so frustrating to me.
Well, somebody's going to take it to court.
I hope they do. I really
Uh-huh.
hope they do. All right. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 3930, and our toll-free number is 1-800-616-9236. Okay, and we're going to go to Linda in North Tonawanda. Hi, Linda.
Hi, how are you?
Good.
I just have a quick question. We're planning on selling our double in March,
Okay.
and I just want to know how much of that money I should set aside.
Okay. Why are you selling it, Linda? You just want to cash in the money?
Yeah, we're just tired of just having the double and being landlords. And
Okay, so let's go back. How long have you had it for?
for about 20 years, 25
Okay.
years.
And what did you pay for it originally, approximately?
Originally it was like 70. No, I'm sorry, like 82.
82. So there's 70. Let's say 70,000 is the basis. So, 21. And you said for how many years?
We've had it for like 20, 25 years.
All right, so let's assume it's fully depreciated, or close to it. That would mean that how much would you sell the house for?
Anywhere between like maybe 110, 120.
All right, so if you have a realtor and there's an expensive sale, let's say you're going to net 110. If you have a zero basis because it's been written off over close to zero basis, let's say that all you have is the land left, then what that means is you'll end up with, let's say you have a $20,000 basis, you end up with a $90,000 gain, all right, which is going to be fully taxable in New York State. The federal may cut you a little slack if your tax rate is under 15%, but I think not. So on the federal, you're probably going to pay about 18, let's say 15,000 in taxes, and New York State probably another 5, so 20,000 in taxes. Now, if you did an exchange and you took you never take the money, you do an exchange from the sale of your rental to another piece of property, and it doesn't have to be active like a rental. You can actually get a partial share of maybe owning a Family Dollar. I know that Russ Gullo is doing that, where you can do the exchange into something like a Family Dollar, and so then the money gets tied up in that, and it's not taxable at all. If you want to take the money out, though, close. I'm thinking that you're going to pay probably $20,000 in taxes. Obviously I can't nail it down, but we'd be very happy to give you an exact amount if you want to give us a call.
Yeah, I just helped somebody the other day. They weren't our client, and obviously for no charge, I ran the numbers, and they came in for a consultation to tell them how much it would cost to sell their rental.
Right, but your option is to
About
exchange it.
So if if we wanted to buy another house.
All right, well, you want to buy a personal house or another rental? Hello?
I'm here.
Do you want to buy another personal house or a rental?
Well, say either or. I mean, could we?
Okay, if it's a personal house, you cannot take the gain from the sale of an investment property and roll it into a personal residence that you're using personally unless it starts off to be rental, and then sometime in the next couple of years you convert it to personal. Then you could defer the gain into that. So what I'd suggest you do is talk to the chief exchanger, Russ Gullo. This is what he does, and he can give you all the ins and outs. But otherwise, you're going to be stuck paying the taxes unless you hold the mortgage. You can hold the mortgage as well, but then you're on the hook, and you're acting as the bank. And if they default, you'll get the property back. But I would talk to Russ Gullo.
And how do I get a hold of Russ Gullo?
I'll give you the number. She can hang up and listen.
Yeah, if you want to hang up,
or call our office.
Linda, what we'll do is, or you can call the office, but Tiffany will get it. You can Google it. It's RJ Gullo and Associates.
Yep.
And that's what he does, and he can give you the ins and outs. Like,
His
for instance,
phone number is 716-675-1500.
675-1600?
1500.
Okay, great.
all right, Linda?
Much.
All right, thank you, dear.
Best of
Bye-bye.
luck.
Yep. Okay, and we're going to go to Mike in Hamburg. Hi, Mike.
Hello, Esther.
What can we do for you, sir?
I got a couple questions.
Yeah.
The first one is my wife passed away in 2017, and this is the first year I'm going to have to file. I'm not sure if I have to file single or.
If she passed in 17, then in 18 you revert back to a single status unless you have children living with you or that are dependent upon you.
No, I don't. So I would file.
So you'll be single.
Okay. Last year, I also got out of the stock market. I had some money into the stock market, and I had to file a Schedule D for capital gains.
Right.
Now, I got out of it last year. I'll probably have to file Schedule D again, but is there any other forms I have to file?
Well, I mean, it all depends on your income. You know, did you do the computation on the Schedule D on page 3 of the Schedule D so that you got the reduced rate, or did you just put it on your tax return on page 1?
I don't remember.
Did you do it yourself?
Yes.
Did you do it longhand?
Yes.
You probably did it wrong. You probably overpaid.
Yeah.
So the computation for capital assets, there's a big tax break for selling capital assets, but the computation is found on Schedule D. So if you don't know that and you just put it on page 1 of the 1040, the IRS will tax you on it. So you probably have money coming back. So if you want to give us a call, I'll be happy to look at it for you to see if we can't save you some money. It could be substantial, Mike.
There's different ways of calculating your tax rate, and you probably use the tax tables, whereas you could have used a Schedule D worksheet to calculate your tax.
At a much lower rate.
At a much lower rate.
Okay.
But, looking at all that you were going through last year,
Yeah. Is there any way before I come in to find out how much it's going to cost to have them done?
Well, the whole thing is, Mike, I'll give you an example. How much did you remember what your gain was?
My what?
The gain. Do you remember what the gain was on your Schedule D?
Not offhand, no.
Like 10,000, 20,000, something like that?
Oh, no, not even that much.
Okay. So, but let's just assume it was 10. And you make a 20% error, that's a $2,000 error. So they're going to pay you back with interest. But that's just an example. we're very happy to give you a price. So just call our office at 632-7886, and we'll give you a firm price.
And I can still amend that last year?
You sure can. You can amend up to 3 years
15,
from the
16,
due date of the
17.
return, or 2 years from when the liability was paid, whichever is later.
Okay.
Okay?
Okay, great.
Thank you, sir. Bye-bye. That would be nice if we could help them. I'd love to help you because it's so tragic, when you lose a spouse. Okay, I'm Esther Gullius, the tax lady from EG Tax. You can go to our website at egtax.com. There's all of our offices listed. We have some tax things that you can download to help you navigate your taxes, little forms to fill out. We're going to take a short break. We're going to break for the news, and we'll be back on the other side with your questions. That's music to do your taxes by. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. You can text us at 3930, and we're talking taxes. So let's see, who's my longest caller here? Mr. Tim. Hi, Tim. How can we help you, sir?
Hi, Esther.
What's happening?
I have an employee who has turned 65 and has dropped our company health care plan and gone on Medicare. So I'm wondering, and we're going to reimburse his Medicare expenses. I'm wondering if there's any way I can make that non-taxable to him.
Okay, so here's the thing. Last week we had somebody that called about paying their employees for their health insurance. There's actually a penalty. If you pay your employee to get health insurance, then there's a penalty that's 50% up to like $36,500. So you want to make sure that you know what you're doing. Do you have an IT? Is there an HR department that you work with at your company?
No, I'm the owner.
Okay, so you can't just do that. You can't just reimburse people for their health insurance. And certainly if you didn't call it reimbursement for health insurance, it would just be taxable. Okay, so unless it's a qualified plan, and like I said, last week when this gentleman called and he was talking with Chris, I said, I know there was a penalty in there. I wanted to make sure they didn't lift it. The penalty is still in the law. So if an employer is paying their employees directly for their health insurance, it is taxable to the employee, and the penalty gets and there's a penalty assessed to the employer. So. Being a good guy doesn't work with health insurance. But again, why don't you call us at the office so we can hear your particular situation? Because, it's like a river. There could be a bend in the river, and we are not hearing everything,
Well, what we've actually done then is we've just increased his salary by the amount of
that's good.
Health coverage.
That's good.
Okay.
I mean, I don't know if in the event of an audit, if they would assess that penalty on you or not. So I would call, so we'll read you the regs and you'll see what you think. Okay?
Okay.
Thanks, Tim. Bye-bye. I mean, it would be a horrible thing if he gets audited and then they say, you can't. And he says, well, that's the rule. You said
after the radio show last Saturday, you were dwelling and looking up and figuring it out.
Because I wanted to make sure, because I knew that there was a penalty that they assessed a couple of years ago. They said it was in the law, but I want to make sure it stayed in the law because they keep changing the law every hour and a half. Okay, let's go back to the phones, and we're going to talk to Alex in Amherst. Hi, Alex.
Good afternoon, Esther.
You're Alex the lady.
Pardon me?
You're Alex the lady.
Yes, well, it's a much longer first name. But
Alexandria.
It was always Alex from the time I was little.
See, that's a nice name.
So, anyway, question. I have received a statement on interest from my bank.
Yeah.
However, I had a CD in which I pulled the money out early and then actually put it into another CD paying higher interest.
Right.
But I have a penalty.
Right.
Now, I have the total on the interest, and then I have an early withdrawal penalty. How do you report that?
All right, so here's the thing. There's all these different forms this year, schedules.
Yes.
So, Tiff, tell her.
Is Schedule 1 is for additional income, and schedule,
where her interest would be.
Where your interest would be. Schedule 2 is AMT and excess advanced premium tax credits. Schedule 3 is for other credits, your non-refundable credits. Schedule 4 is for other taxes. Schedule 5 is for estimated taxes and your net premium tax credit. Schedule 6 is for your third-party designee.
Okay,
so
but
hers would go
on 2, right?
Schedule 2 is for AMT and excess.
Oh no, 1 then.
Schedule
it's going 1. So
Schedule
you're going to
1.
put the additional income under interest, and on Schedule 1, there's also an adjustment section that talks about premature withdrawals. That's where you put it as an adjustment.
Okay.
Okay.
So take that.
So you have to put the income in at the top, and under the adjustment on Schedule 1, you take the adjustment.
Okay. Yeah, I thought that taxes were going to be easier this year.
Oh, it is not. I mean, it's bizarre because the what used to be page 1 and 2, which made sense numerically because it flowed through. Now you go over to a schedule and you have to bring over a total, and you don't know where the total even came from.
I know. It's driving.
It's really it's bizarre.
We were talking about that before the show.
Yeah, it's just bizarre. But yeah, it isn't easier.
That's really interesting. One other, just a general question: standard deduction, married joint over 75.
Okay, married joint. So it's going to be 24 plus 26. So it's because 2,600 because you're over 65. So it'd be 26. 26. Right around 26,000.
Yep.
Okay.
All right, that's it. Thanks.
All right, thanks, dear. Actually, 26.3. Okay.
6.3.
26.3.
Okay.
All right. Thank you.
Good
Bye
luck.
bye, Alex. Nice name. Okay, let's go to Elizabeth. Hi, Elizabeth.
Hi. How are you today?
Good. What can I do for you?
Good. I have another RMD question.
Yeah.
I've already gone through the federal end of it, and it looks like I'm not going to owe any taxes. But my question is about the state. Will I owe state taxes?
All right. So are you a married lady, single lady?
I'm single.
All right. May I ask your age?
Pardon me?
May I ask your age?
Oh, sure. 71.
All right. And then how much did you take out of your RMD?
9,800.
Okay. And do you have any other source of income besides Social Security?
Just this.
Okay, so the $9,800 is going to be is a subtraction on New York State, because you're allowed to take 20. All of your pension is tax free if you're retired on a federal, state, or municipal pension. If you're not, and it's an IRA or a non-federal, state, or municipal pension, then it's limited to $20,000. So your $9,800 is going to be a subtraction, so you're not going to owe anything.
Okay, so that means I don't have to pay, right?
That's correct.
No state withholdings.
Right.
Right.
Because
okay.
You're good.
Okay.
Great. Well, thanks a lot.
Thanks, Elizabeth. Bye-bye. I'm Esther Gullius, the tax lady from EG Tax. We have 30 area offices to serve you. We're open 9 to 9 Monday through Friday, 9 to 5 on Saturday. On our website, it has a little thing called Ask the Tax Lady, and you can email us because we're open.
We
and
are.
by the way, the IRS is open too.
Yep.
So just to put your mind at ease. And we got Dave in Amherst. Hi, Dave.
Hi, Esther. Thanks for taking my call.
Yeah, what can I do for you?
Well, I had a timeshare, which I'm sure you're a little bit familiar with.
Mm-hmm.
And luckily for me, I found a way to actually get rid of it with the help of a law firm in Florida. And basically, I have surrendered it back to the resort in exchange for just relieving me of all
the obligations
for maintenance fees.
Right.
Okay, so I'm just wondering. I was kind of told that there could be a tax, it could be a tax write-off.
Well, it can't because it was personal. When you sell something that's personal, like a timeshare, personal residence, and you not a personal residence. Let's say a car, your wedding ring.
Yeah.
If you sell it at a gain, the gain is taxable. The reason I took out a house is because if you live in it for 2 out of 5 years, the first $250,000 is tax free. If you're single, $500 married joint. So the house, but your timeshare, even though it's a capital asset, was really personal. And so when you sell it at a gain, it would be taxable. But if you sell it at a loss, it's not deductible.
Okay, so I didn't actually sell it. I
Well,
literally
you did sell it.
surrendered it.
You sold it.
Got not a penny back.
All right,
it's
you sold
considered
it. That's
selling
considered.
it.
It's like a sale. You surrendered it. You liquidated it. It's gone. So it's a loss. It's not deductible.
Okay.
Okay.
All right.
All right. Thanks, Dave. I mean,
Good question.
you wish,
Yep, really good question.
Wishing and hoping and thinking and praying. Okay, we
But
got
the law is the law.
Right. 8030930, 8030930, star 930 on a cell phone. Love to hear what you have to say. And we got Carol in Lancaster. Hi, Carol.
Hi. This is probably a pretty silly question.
Nope, not silly.
My neighbor has told me the past few years I don't owe any income tax. My only income is Social Security, which is about $8,000. I just take out money out of my IRA, and then I have a $24 interest from a burial trust.
Okay.
So I wind up not owing any state or federal income tax. And she told me I'm being stupid always filing when I don't have to because I don't owe.
Well, if you're under the minimum filing requirement, you don't have to file.
Oh.
You're not being stupid. And then, Carol, do you own a home?
Pardon me?
Do you own your own home?
Yes, I do, but
how much is the house worth?
Don't, because it's I have the right of.
All right, so you have a
living
a life estate, right?
Life estate, right?
Okay, all right. But if your house was worth less than $85,000, you would have qualified because you're over the age of 65 for a refundable property tax credit. So IT 214. So that's why I wanted to make sure.
And then some people like to
Little
file
dollars
because
on taxes.
to get the enhanced star. The town likes their tax
right,
return.
but if there's no withholding, you're not stupid, but you really don't have to file.
Okay, well, I am stupid, so.
Okay, Carol.
Appreciate it.
Thank you, dear. Bye-bye. I'm Esther Golias, the tax lady from EG Tax. Okay, we want it while we're waiting for more calls to come in. We got some coming in. This is how a tax return works. First of all, your page 1, this new thing, is the only thing they have is your name, your address, your Social Security number, and your dependents.
That's it.
Now, you're not going to get anything for your dependents except for credits. So if it's a child under the age of 17, you're going to get a child tax credit. And if it's a child or other qualified dependent family member, you're going to get $500 credit. That's where the credits come from, okay?
Right.
The next page, though, is kind of a summary of your income.
That's
okay?
right.
There is no longer a 1040A or 1040EZ, but all your income is from wages, interest, state refunds, maybe, but only if you itemized last year and if you didn't have any credits from New York State, because many people put their state refund down as if it's taxable when in fact it may not be.
That's
In
right.
most cases, it isn't. Your unemployment is taxable, gambling and miscellaneous income. That all is part of how your tax return works. Then you compute the net profit on your rentals, your self-employment, your farming, because then those are separate schedules. And you also include income from capital gains and losses. And if you're in the 15% bracket or lower, you pay 0%. That's why when that gentleman called a little while ago and he said he didn't use but you got to use the Schedule D computation.
That's
If you
right.
don't use the computation, you overpay.
Yep.
Right?
Yep.
And then Social Security is partially taxable.
Depending on your other income.
Right. If half of your Social Security added to your other income exceeds $25,000 and you're single, then half of the excess over $25,000 is taxable. If your Social Security added to your other forms of income and non-taxable income, married filing a joint return exceeds $32,000, then half of that excess is taxable as well. So Social Security can be taxable. Then the other thing is you want to make sure that you list your pass-throughs on your K-1s, if you're getting K-1s because you maybe have a Subchapter S corporation. And don't forget your alimony. Alimony is still taxable if it's a pre-2018 divorce.
That's right.
Right? And then sale of depreciable assets, like we were talking about that lady that was selling her rental property.
Right.
That's also part of your income. So all of that is taxable.
Yep.
All right? And if it's specific, everything that you have is taxable unless it's specifically exempt. So we start off with that. Okay, let's go to Jay in Buffalo. Hi, Jay. How can we help you?
Hi, Esther. Thanks for taking my call.
Yeah.
So, it took 2.5 years for me to finally get my Social Security disability approval.
Yeah.
And so, in 2018, I got a nice lump sum payment.
Okay.
And so I'm wondering, is there like an income averaging where I go back to previous years?
Okay, but let's talk. So, you know what, though, Jay, do you mind waiting for about 5 minutes? 3 minutes. We're going to take a short break and we'll be back, and I'm going to ask you about all your income. You got a minute?
Okay. Yep.
All right. Hang on, will you? Thank you. I'm Esther Golias, the tax lady. We're going to take a short break. 8030930, 8030930, star 930 on your cell phone. We'll be back in a minute. Hey, I'm Esther Golias, the tax lady.
Well, that's Frank. But
yeah,
the
that's
guy,
Frank.
The guy singing the song was Lady Gaga. We saw this movie. He had a lot of nominations.
Oh, I love that. You mean Queen?
Queen.
Yeah, I love Queen. That was great. I love that movie.
Lots of Oscar
I'm
nods.
Esther Golias, the tax lady. 8030930, 8030930, star 930 cell phone. And my buddy Jay. All right, you ready, Jay?
Yes.
Okay, so how much did you get?
I got like 80 grand.
All right. And do you have any other source of income?
Over those past 3 years?
No. Last year, when you got the money, did you have any other source of income?
2018.
No.
All right. So this is how it works. So your half of your Social Security, which is $40,000, is taken over $25,000. So we have $15,000 over divided by 2. So $7,500 of that Social Security is going to be taxable. You don't pay taxes. Nothing.
Yay. That's a good answer.
You don't pay taxes on it. When you do the computation, it's not taxable.
So is this something do you think I could do online? Or?
No, you don't have to file. You don't owe any taxes.
Oh, I don't have to file.
You don't owe any taxes, Jay.
Okay. That's good news.
Right.
Well deserved.
So
yeah.
Are you happy?
Yes, I'm very happy.
Yep. So, and if you wanted to email me, I'll show you the computation and you can put it in your records. So, okay.
Actually, I did submit it on your web form about a week and a half ago and hadn't heard anything.
Really?
I call in. Yeah.
Well, if you go to Ask the Tax Lady, it comes to me. So
Unless
if
there's a break in the
no, but I think that some of the other people are getting them, and I want to make sure that I get them. So anyway, but you're in good shape, Jay.
Okay, awesome. I really appreciate it.
Thank you, sir. Bye-bye. And let's go to Rick. Hey, Rick, how can we help you, sir? Hello.
Well, thanks for taking my call.
Yeah.
So if someone has zero income for the year,
yep,
and they have an opportunity to sell an asset that might have a capital gain, what would the capital gain rate be?
0. Well, depending upon how much of a gain it's going to be. How much of a gain will it be, Rick?
200,000.
Okay, then it won't be. Then it because if you were in the 15% bracket, it'd be 0. But on the 200,000, there would be you would pay a maximum of 20%. So that would be, $40,000 if the gain were 200,000.
And is that because the gain is treated as income at that point?
Yeah. If you sell a capital asset, it's taxable. but there's a special computation. If your total taxable income's under 15%, then it's going to be at 0%, the capital gain portion. But in this situation, you would be more like the 20%. So it would be about $40,000.
And so, for simple math, what would be if the asset could be divided and sold over a couple of years?
But that would be much better. Why don't we talk kind of specifics? What are you selling?
So, stock.
Okay, you're selling stock.
And it's stock in a company.
All right.
And
is it your company?
No.
Okay. So it's a publicly traded company?
No.
No. So this is a private company.
Correct.
Okay.
And so it would be, managed such that it could be sold to different people over different time periods.
Well, that would be good, because if you had no income and you could keep yourself under 15%, then you'd pay 0% on it over a number of years.
And
I mean, for as long as they keep the law the same. I mean, I never know how long the tax law is going to stay the same.
For simple math, what is the amount of gain per year then to be under the 15%?
Well, are you single or married?
Single.
All right. So your standard deduction is $12,000. So to be under 15% later, 15. So about 38 and 12, 10, 3, 4. About 50,000 a year is what you'd be at to be under the 15% total income.
Right. Yeah. Thank you very much.
All right. Talk to you later.
Have a great day. Bye.
You too. Bye-bye. And then we got, yes, ma'am.
Oh, I was just going to say, great way of summing that up.
Yep.
Yep.
And then we got Joe. Hey, Joe. Hello, Joe.
Hi, Esther.
What's happening?
Well, I have a quick question. I'm on Social Security with my wife, and we also get a private pension.
Okay.
The total of it is $60,156.
The pension?
How much is the pension?
I'm sorry.
This pension's $60,156
in total. That's with Social Security.
How much is your Social Security?
One is $25,872. And the other one is $9,072.
Okay.
So what I'm trying to get a handle on is roughly, am I going to be subject to some taxes on that?
Okay, so you mean on the Social Security?
Well, yeah.
All right, so half of your Social, I'm doing this as quick as I can.
How much was all 17, of your income, Joe?
So, but how much is your pension?
Hang on one second. I can't hear you well.
How much is your pension?
My pension is $25,212.
Okay, so, all right, so
are you over the age of 65?
Yes, I'm 69.
Right. 42. So 42 over 32 is 10. So we get 5,000 of Social Security can be taxable. Plus 25
How much did you
is
say
30.
Your pension was, Joe?
Yes, you are going to pay some taxes. Not a lot, just a little bit.
$25,212.
You're gonna have a small liability.
But he's at $24,000 plus a little extra for over the age of 65.
Right, so it says 26.3.
Okay, and his pension is $25,000.
But 5,000 of Social Security is taxable.
Okay.
Yeah, because when you add the 34,000, he's got 35,000 in Social Security. Half of that is 17. 17 added to 25 is 42.
Okay.
Subtract 32 from 42 is 10. 10 divided by 2 is 5. 5 gets added to 25. That's 30, and his standard deduction is 26.3.
Okay.
That's his.
So
that's
just
my
a little bit
cipher.
of tax.
Not much. I mean, so if you end up with $3,000 taxable, it's going to cost you $300.
Okay. All right.
And none on the state.
And nothing on the state. Okay, Joe?
I don't use you yet, but we're coming to you next year. You're going to be doing our tax.
What's wrong with this year?
Well, unfortunately, I'm tied in with a guy, but
that's all right. That's okay. We love you anyway, Joe.
After I talk to him.
All right. Thanks, Joe.
Thanks, Esther.
Bye-bye. Yeah, we just love everybody, right?
You love
All right, we're going to go to Ron. Hey, Mr. Ron, how can we help you?
Yeah, hi. I have a grandson-in-law that he lost his wife 3 years ago.
Okay.
He has 2 children.
Uh-huh.
And I had told him that I thought that maybe he could be getting some Social Security allotments. Is that true?
Okay. Well, how old are the kids?
4 and 7.
And the mom passed away?
Yes.
Had she been working and paying into the Social Security?
Yes.
And did she work at least 10 years?
No.
Okay.
They're 20, so no.
Oh, she was 20?
Yeah, it's 26.
Oh, my gosh. That's so sad. She wasn't on Social Security disability, was she?
No.
Yeah, well, we should never make a final decision based upon somebody on the radio. It doesn't cost him anything to call Social Security. They'll ask her Social Security number, or you can talk to the financial guys, Mike Hayflick. I mean, it sounds to me like she wouldn't qualify, but never just give up. Find out.
Yeah, okay, thank you.
All right, thanks, Ron. Yeah, that's so sad. It is so sad, and so many times it's drug overdoses. That's his situation, but it's so sad.
And don't forget that that guy would be head of household probably, unless the person passed away within the last 2 years. He'd be qualifying widower.
Right.
And if he's a low income person, he'd get earned income credit.
Right.
So
if he's working.
Yeah.
Right.
Yeah.
Anyway, until next week, we don't go far away. We're just over there at 1890 Colvin. And all of our branch offices. If you need us, you can go to our website at egtax.com. We're always here to help you. The IRS is open for business. They're acknowledging returns, and I think now that they're back to work, they might even process refunds. Remember, if you got an earned income credit or additional child tax credit, they're holding it up till the middle of February. Until next week, I'm Esther Gillias with Tiffany Fabian. Thanks for listening. Bye-bye.